Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by James Anderson of SD Bullion. James, good morning. How are you?
Great. Thanks for having me on your channel.
It's a pleasure to have you here. Just to give a date stamp, there's a lot going on in the markets at the moment. It is Monday, the 27th of October. And at the time that we're recording this, I was seeing the gold is just under $4,000, silver around 46.50, give or take. James, I know that the question that people are going to be asking, given the fact that the price has dropped a little bit, is this possibly a good time to be adding to physical positions with regards to gold and silver?
Yeah, I think so. I mean, it was inevitable we'd have at least some type of price pullback and consolidation. Gold and silver have been doing extremely well year to date. So for it to have a pullback is good because there are people out there who were kind of caught in the fact that they don't have a position yet and or they're new entrants into the marketplace. So it's good that it's pulled back for them, and it's also healthy just in general. You don't want the price just going up so that the actual technical base becomes kind of unstable. You need to consolidate some of these gains and shake out the weaker hands, and I think that's what we're doing right now. Ultimately, silver, how far can it go down? Maybe a little bit further, but ultimately it's got to go beyond 50 and then 55, and we'll get running again. Whether that happens this year or next, we will see. But it's coming at some point. You have even establishment spokespeople out there like Metals Focus just reported this past weekend that they think $60 silver next year is a gimme, $5,000 gold gimme. Platinum, palladium both do well, and they're both in deficits. So silver as well is in a deficit for 5 years running. So the world needs a lot more of these white metals, and we basically just don't have enough. So we're stripping our excess supplies, and at some point, these different market makers are going to have to go out in the real world and buy this stuff at a premium, and that's going to shoot spot prices up. So, and then as well, everybody here probably knows gold has been central bank bought record size since 2022, 2023, 2024, and now 2025. The forecast is that it will be a large year as well. So you also have the fact that institutions in the West, like CIO of Morgan Stanley coming out and saying, 60-20-20 is the new portfolio mix. I mean, if you had a situation where, Western institutions start going into gold heavy like that in size, that'll make the bull market scream. I ultimately think that will happen, but it'll probably take a little bit longer. But that the Western capital inflow into gold is what probably takes it into a mania, probably takes it to five figures eventually.
Will gold continue to lead the way like it normally has done? And what I mean by that is that you've mentioned about the structural deficits that we have in silver, platinum, palladium. And I'm sure most people listening to this would be aware of that. But historically speaking, gold normally leads the way and then silver violently catches up. Do you think that's going to be likely again?
It kind of is in this rebound right now. We got down to like 78. The spot gold silver ratio got down to 78 for listeners. All that is just gold divided by silver. And so it got down to 78 and it's recently sprung back up to 86. So we're having a reprieve now where gold's outperforming silver. That will reverse probably in short order, and silver will start outperforming gold again. And so, yeah, it's 86 historically is very high. There's a lot of people who, when they look at the spot gold silver ratio, they just look at like the last 30, 40 years of data. So it's kind of skewed to the upside. But on like a historical basis or in any major gold bullion bull market, it precipitously drops down. In 2011, it got down to 30, 32, 30, 31. And that was 2011 was a tiny silver and gold bull market. It wasn't like it is today where it's now global, and the internet and the speed of getting in people's lizards brains is just so much more accessible. As people probably have seen, there's just been sellouts, all types of dealers all around the world in terms of people buying silver and buying gold of late. And so, yeah, the spot gold silver ratio at 86 just screams good value for silver. For it to go back towards 60, which would be kind of the norm of late in the last few decades, would be pretty typical. But in a bullion bull market, it goes further. For it to get back down to its 2011 low near 30 is definitely possible. And it's probable to go below that in a mania phase. In 1980, it got down in the teens.
Mm.
And so, for a situation like that down the line, it's possible. It's probably something next decade that would occur in a mania phase.
I was going to ask you about the gold and silver ratio, but I think you've just covered everything there because people have different ideas of what they're looking for. So just so I've got this clear, what you're saying is that when we get around to a true mania phase, you wouldn't be surprised if that GSR drops down into the teens again. You're saying it is possible that it could do that.
I'm saying for sure, conservative target is 30, going back
Mhm.
toward where we were in 2011, and a probable, it's something that's possible, and I think it's probable that it goes below 30. To bet on that, to put all your eggs in one basket, thinking I'm going to trade all my silver when the spot GSR gets to 15, because Newton said it was 15, like that's insane. Like, I mean, in this world, you just kind of sometimes you have profits there sitting waiting to be taken. You got to take them, right? And so the spot 30 GSR, if it gets near that level and you really wanted to get more gold, and so you then trade some silver for gold, that's fine. That's what's the worst case? It goes beyond that. Oh well, do it again. You don't move your entire
Mm.
position. You just do a certain amount.
Well, as you said, especially if we're in the 80s at the moment and it gets down to that, and you've more than doubled your position size
Yeah,
if you then.
almost triple. You damn near tripled your buying power in terms of
Mhm.
gold by using silver as the vehicle. So, that's one thing. And there's other ratios that are just out of whack. I mean, the US S&P divided by silver is at a level that's well above 1929 highs. It's at like 190, last time I looked. And that got down to 25 in 2011, right? So think about it. It's a factor of like 8 that it can
Mm.
outperform almost, 7.5 just to get back to 2011 low levels. But in 1980, it got down to like 2.6. So the multiplication of outperformance is something silly, like I mean, like 60 or 70 times, because if it does it from here to there, right? I mean, so if you want to own, what you want to do is you want to buy the US stock market when everybody and the brother's spitting on it. That's usually when it's a generational buying opportunity. And they were spitting on it in 1980. Okay. And that was the time to be going hog wild, buying, S&P shares and buying big major corporates in the United States. We probably will come upon that again, but that's probably later down the line, later 2030s, when the social
Mm.
contract comes up. And a lot of people feel like the stock market is nothing but a scam and all that kind of stuff. That will be the broad feeling in the base, I think, for most of the younger people in this country, and that'll probably be the time when you want to allocate money into it, because usually that's when you find good value when things are treated as such.
Well, contrarian thinking, full stop, isn't it? I think it's looking at positions when other people aren't looking at it. James, you mentioned the fifth year of the structural silver deficit. I think the Silver Institute said it was about 117 million ounces in 2025. So
Yeah.
I know that you look at a lot of charts behind the scenes with regards to paper silver, COMEX, LBMA, the SGE over in Shanghai. This is an open-ended question, so apologies for that. What's going on behind the scenes in silver at the moment? What are you looking at?
So we have a deficit, that's run up to about 800 million ounces total for the last 4 or 5 years. And 800 million ounces is basically, the new line mine supply every year for silver market. There's some recycling that gets added on top, but right now we're demanding about 1.2 billion ounces. So we're demanding almost 50% more than we newly mine. We can get a little bit of that covering with recycling, but generally we have to pull from other inventories, would be them opaque or yanking them from unsecured ETFs or pulling them off of warehouse stockpiles like COMEX or London. And London recently has gotten into a jam because that's what's occurred. They have, a large swath of silver sitting in London, but it's already allocated to these unsecured ETFs. And so you can't necessarily yank those free and clear. You have to have the APs do some type of contrivances where they didn't, they borrow shares and then they convert it into metal and they ship it out to places for, they basically arbitrage the situation. I mean, the fact that the custodians of these ETFs are making markets in those metals is a conflict of interest. That's first and foremost. The fact that your custodian is literally using your shares or borrowing shares from other people to tamp down the prices of silver as time goes on, it's a total conflict of interest. So if you are going to be getting into ETFs, just stick with like the Sprott asset funds like PSLV or there's a few others. There's Fizz for gold. There's also a Canadian one. I'm forgetting the name of it, but There's like three of them that they have out there that are legit. They actually do go out in the market and they actually do buy 1,000 ounce bars. And it's very rare that you see 1,000 ounce bars withdrawn from them. So it's basically a way to put more pressure on the system and to actually get more of a legitimate price discovery in the metals. So you have that. London is being called out. I think India demand is what really kicked this off. Their ETF demand of late. I think the last increase of ETFs in India, there's about 10 of them there. I think they added over 20 million ounces. And that really basically squeezed down the float in London. And so you saw the lease rates in London, which is basically a signal that they went sky high. And that's basically a signal that they're out of fresh metal to use and to settle trades with. It's anywhere from 40% to 200% overnight, which is just, this is something that we've not seen since Warren Buffett and Berkshire Hathaway came in and raided the silver market in 97, 98 for their 129 million ounce position. You saw lease rates spike like that in early 1998. But ever since then, we never had a situation like this where London's just been caught so dead short. So the situation on the COMEX side is we have about 500 million ounces of silver in those warehouses collectively, but a lot of it is basically not available. I mean, there's a registered pile, and we've had maybe 30 million ounces outflow the last month during this London pressure. That doesn't necessarily mean all 30 million ounces are going to London, but I would suggest the large swath of it is, and that might be buying them a little bit of time. But the problem is that they're probably short hundreds of millions of ounces in terms of demand that's coming and that is existing. And so they probably had to tell India to buzz off until Q1 next year, maybe. And they're probably turning people away. And so you have a situation where the Shanghai Futures Exchange, the Shanghai Gold Exchange, their silver pile has precipitously dropped too since 2021. I believe 170 million ounces has fallen out of those two exchanges since 2020, late 2020 peak. They only have about 71 million ounces left. And for a country that literally uses the most industrial silver in the world, just having 71 million ounces in your exchange is really not that much. So we're in a situation now where it's acute pressure on all three fronts. These are the major places where the price is discovered between the COMEX, London, and Shanghai. And their two exchanges. This is really where the silver price gets discovered day to day. And so papering it over, it might work in the short term, like maybe what we're seeing right now. There might be a little bit of a reprieve in price, but ultimately it's got to go higher in order to incentivize enough silver to come back into market to meet this demand. Because this demand is not just industrial, which has been consistent and large and growing, but now it's becoming store value demand. And so the combination of the two is absolutely deadly for people caught short.
With regards to other areas of demand for silver, I read a couple of articles last week that looked at the fact that I think it was India, if I'm not mistaken, are looking to, or it might have been Russia as well, are adding silver to their balance sheets as well. So there's also potentially central bank demand in silver that is also going to have an impact on a market that, as you've just said, is in a massive structural deficit as well. So that's going to have a massive impact.
Yeah, that's the rumors right now. Russia has been talking about doing that, just specifically. I'm sure the Chinese have been doing that for a long time. I would imagine a lot of Chinese warehouses have been opaquely building up their stockpiles because anyone that manages, a manufacturing base that needs silver knows that they have to have silver, or else their products are not going to be getting made, or they'll be being made in a way that they're not efficient. Right? I mean, we wouldn't be able to have this phone call without silver. It's essential to what we use day to day for our quality of life. And so anyone who has, some type of product and or, in use case where silver is a must, you kind of want to front run this because this is going to become a problem. Running into shortages of silver is not just simply because, people want to store it as a store of value, but for having it for industry is absolutely critical. It's very difficult to thrift out the silver that we use because it basically has all the things that you need. It's the most reflective, it's the most conductive, it's ductile, it's not that expensive compared to gold. So it's used a lot in virtually every electronic that we use, from your car to these computers. It's just essential to our world. It's second only to crude oil and the amount of things that it's inputted into.
In terms of what happens next, and I think that you've alluded to this already, that things are starting to, should we say, creak in the background. So, given everything that you've explained, and again, given everything that you look at on a daily basis, how do you think this is likely to play out in silver specifically? How do you think this is likely to play out moving forward?
So I feel like the $50 an ounce level is kind of like the old $2,000 an ounce level for gold. I mean, if you remember back to the 2,000 ounce level for gold, we battled around that level for 2 to 3 years, back and forth. And it was only a matter of time, I figured, before we built a strong enough structure and base and an impetus to push off and really start levitating in price. And that's what we did. And now we're double that price. And silver's $50 an ounce, level is critical. It's very important. And I think we're going to probably build a base. We're going to get back toward 50 at some point and then take off. It won't take as long as gold did. Gold took 2 or 3 years to move sideways. I mean, silver would get back to 50 and then 55. It would be like a 2 to 3 month stretch, instead of 2 to 3 years. Silver is just one of those metals that's more dramatic in its moves, be it up to the upside or to the downside. It's a much tinier market. I'm talking hundreds of times more gold notionally is traded per day than silver. It's just a much smaller market. And so it doesn't take a lot of capital to come into the market to start moving it around and pushing it around, whether it be to the up or downside in the short term. In the long term, silver silver at $50 an ounce is basically, in order to catch what gold's already done, it basically has to double from that plateau. It has to get to triple digits really to equal what gold's performance has been to date. And by that time, who knows where gold will be? I mean, there's projections for gold next year to hit $5,000 to $6,000, and these are conservative, consultancies and banks that are saying that. That's not just me sitting here on the internet saying, oh yeah, we're a dealer of gold and silver, and it's going to go to 6,000. It will likely go up next year, but the point is that the system is changing in the sense that we're moving away from the fiat dollar dominance. And when we do that, we have to go back towards something that the world can agree upon, that is a store of value, and that is going to be gold. And so what we're having here is the scales of our fiat currencies fade away, and gold start to reaccount for virtually all of them as time goes along. And so in that situation, you have gold at 4,000 roughly now, and it's going to do multiples from here. I mean, for it to go 5 figures over the long haul it's common sense if we're going back to a system that is weighted in gold.
I know that most people that listen to these YouTube videos and this podcast are actually from the United States of America. So there's going to be I think a lot of interest in terms of what you have to say. James, just want to add something to that point. So what we're saying is that if there's a lot of challenges behind the scenes in silver, but gold is going to continue to move, which again, it's very likely given the circumstances. Again, going back to that gold and silver ratio, even if nothing changed in silver per se, and gold continued to increase, or the value of the fiat currency continues to decrease, whatever way you want to look at it, and the GSR continues to go down slightly, then silver naturally is going to have to, as you say, at least reach triple digits. That's just simple arithmetic.
Yeah, generally in a gold bullion bull market, gold leads, and it's already led. I mean, gold is at $4,000 an ounce, and it has led, pretty consistently for the last few years. And silver has kind of taken its sweet time, but of late, it's starting to show itself. The fact that we hit $54.50 not too long ago, that's now the level where we get past that, we go to 55, and we'll probably start running pretty quickly into the 60s. And so, yeah, we are at that level now. I know you look at the price right now at 46, you might think, oh, it could flounder here forever. I don't think so. It's a question of months probably before we're off and running again, because the situation fundamentally is just so acute. And so, yeah, I would suggest that people who are in this situation, you have to think about it. Look, silver bullion below $50 an ounce is a value stored because it's going to do multiples. You're going to multiples in terms of triple digits per ounce over the long haul. Maybe the first impetus gets us toward, $100 silver, but the later impetus gets us to $400 or $500 silver. And that's probably later in next decade in the 2030s that happens. But we're moving into a commodity super cycle I'm pretty confident in. While we write off all the debt and unfunded liabilities that the United States and other Western countries have accrued, there's no chance they can pay that in real terms. So in order to let that get paid legally, they have to just devalue the currency. And that's really where we're going. As far as your eyes can see, is you're going to get negative real interest rates on any savings sitting in bank accounts or in bonds. and stocks, people are going to run to those because they see them nominally being pretty high, and that would be a
Mhm.
place to hide for inflation. But ultimately, those are going to melt down to gold as well, and they're going to melt down to silver as well. That's just the way it works. When you go into these bull markets for gold and silver, it outperforms every asset class. And I don't care what you're talking about, be it real estate, be it stocks, be it bonds, they're all going to get melted down versus bullion in this type of phase.
You mentioned $50 silver there, then you mentioned also $500 silver. So obviously that's a tenfold increase. I agree with you. I don't think there's many things that we can look at nowadays and go, well, hang on a minute, that has the potential to go tenfold. I'm also interested in your time frame as well with regards to 2030s, because other people that I look at, follow and speak to, people are looking at 3, 4, 5 years. Maybe they're not looking further along. So why that time frame? Is that just how long historically these things take to play out?
Yeah, you have to remember politically, we're running into a place where it's totally different. We're basically in a destruction phase of the old system. The old system being the fiat U.S. dollar dominance, and we can already see that waning. The fact that gold is priced at a premium to crude oil kind of tells you that we're going back to gold pricing things in real terms. And crude oil is pretty cheap versus oil versus gold, and it's about as cheap as it was during the late 1800s. There was a long stretch of time where gold was just at a premium to crude oil, and we're back in that level, and that can go on for decades. By the way, you can have a situation where gold is just that much more of a premium to crude oil, and I'm guessing that's probably where we are and where we're staying for a while. In terms of overall, it's just the fact is that you've lived through a time where gold and silver were systemically suppressed in value. And that's unraveling. That's coming undone. And in that situation, they're going to revalue acutely versus virtually anything you can name.
Going back to fundamentals, and you've covered gold, you've covered silver. You also mentioned the deficit in palladium and platinum as well. I know there's going to be listeners to this that are going to want me to ask you about PGM. So, taking the deficit aside, and again, given what you look at on a daily basis, what other things can you see in both the platinum and palladium markets? What do people need to watch out for?
So they're both critical metals for various industries and various, like the fact that hybrids, for instance, are the winner. They're the full-on winner. Like, it's not electric cars that are winning the race in terms of manufacturing and automobiles worldwide. Although electrics might be doing okay in China, for instance, but they're not in the rest of the world. Mostly hybrids are the winners, and they use a lot more PGMs than people know. They basically have to use PGMs to be efficient. So the loading that they require is a lot larger than your regular gasoline engine. And so we're just stripping away more of the supply, and we're going to run into shortages there as well. Palladium and platinum are critical for automobiles and for other industrial applications. So you have a situation with palladium. It's like half off its nominal price high. It hit 3,000 roughly in the early 2020s. It was the first of the major four precious metals to really go boom because it ran into a shortage because of Volkswagen's Dieselgate. Everyone and their mother kind of switched over to palladium in their manufacturing process, and that created a price run from 600 to 3,000. So in short order, it happened over a handful of years. And so palladium's right now half that price. I think it's good store value if you have a view that stretches out to the mid 2030s. If you have palladium, say $1,600, $1,700, $1,800 palladium, you buy bullion palladium coins, for instance. Down, by the mid 2030s, I would imagine that would be multiples of where it currently is priced, probably closer toward high, four figures, I would imagine, than lower. Platinum is a situation where it is cheaper to gold than, almost any time historically over the last, handfuls of years. You have to go back to pre-1900s to get prices where platinum was so cheap compared to gold, and that's before we even knew how to use platinum. We basically just discovered platinum around the early 1900s and all the industrial applications it's used for. Platinum is more rare than gold. In terms of the entire size of the platinum stockpile in the world, if you stuck it all together, it would fit in a 2-car garage. It's a joke. It's a small cube. It's not big. And it's super cheap, and it's got a great brand. The fact is that Chinese, I'm sure, are looking at gold and they're looking at platinum, and they're thinking, I might as well buy some platinum too, because I remember in my Chinese brain, I can remember in 2008 when platinum was $2,300 and gold was what, 1,000. So it went to 2.5, 2.3 over the price of gold, and right now it's much less than half. So the idea of those two metals kind of switching as time goes along after we've restructured the system, and platinum probably goes back into a massive, screaming bull market and it goes up vertically. It wouldn't surprise me to see it go back to 1 to 1, because historically that's been kind of common to have platinum and gold roughly the same price. So platinum to me just has a lot of upside to it, and it's just a precious metal. It's basically something that you can get relatively historically cheap versus gold at the moment. And so I would suggest, a small single digit of your bullion allocations be in the PGMs, because they just have a lot of potential. They may just take a little bit of time to perform, but they've already been performing of late. And there'll be some lags here and there. It'll be wild and volatile. But over the long haul, all the white precious metals are going to perform, and gold will too. It's just a question of having, what allocations you're going to put in each bucket.
I also think that having some form of plan, and I keep saying this on the channel as well, it's okay. We can talk about this stuff all day long, but as you mentioned at the start with, when the GSR gets down to 30, for example, well, then what's your plan? You don't, necessarily get rid of all your position. So I would urge people to go away and think about what they want to do and do what works for them ultimately. It sounds to me like there's a lot of potential across the board anyway, but especially again in platinum, because you mentioned the automobile industry and those historical ratios with gold. James, is there anything outside, and I know you've mentioned oil as well, is there anything outside, any other elements, any other commodities that you've got an eye on that you think, hang on a minute, this has got potential here?
I would think crude oil, like if you take your time and try and find the bottom there, if you look at the chart, the way that it's moving, it's got this look where it's, just going sideways and down for a while now. And at some point it's going to turn up, and crude oil is going to get more expensive. All that takes is really like a geopolitical, problem. You get a major war going somewhere, say Asia invades to Taiwan and trade slows down. I mean, crude oil can snap back and rally very, very sharply. So it wouldn't surprise me in the next few years to have a year where crude oil outperforms the precious metals. That would be pretty common in a commodity super cycle. They sometimes pass the baton to one another between years. So crude oil, I think, in terms of the biggest potential out there, like just in general, that's one commodity I look at. I also look at coffee as one of the softs that's probably going to go crazy at some point. It's already kind of breaking out into a new pricing paradigm, but eventually coffee is going to get so expensive, it's going to be, something that people only with money can afford. It's not going to be something that the masses can afford generally. So you can expect coffee probably will, it could probably triple in terms of its regular price in the next few years. And that's just the way it'll be. It'll be a delicacy. It won't be a staple that you see at your local McDonald's. The Arabica beans, the coffee price will be a lot more expensive, I would suggest.
I have a feeling that sentence might upset quite a few coffee lovers here, but we're all about the truth and reality here. I certainly have noticed the prices, and again, I'm here in Mexico, and I've noticed the prices go up considerably as well. In terms of in terms of the major indices, I think you've already alluded to this, that there's not going to be a case of onwards and upwards forever. So again, if we can bring these into what's going on, obviously there's a lot of buoyancy at the moment. They've probably got a bit more room to run. But again, what are your thoughts on what you're seeing in the equities markets at present?
Yeah, so the S&P 500 is about 6,700. I could see a situation down the line where it's 8,000, say, but it hasn't kept up pace with gold's performance, and silver's outperformed it. So nominally it might look impressive, but in true reality, in true terms of inflation, it's underperformed, especially the precious metals. I would expect them to outperform the stock market for a long time coming. Back in 1980, the Dow Jones Industrial and gold got back to, like, for a very short time frame, got back to 1 to 1. And the Dow Jones today is 47,000, right? So you go back to a mania phase like 1980, and you're talking about just 10 bagger in gold versus the Dow. It's just that's the type of purchasing power gains that can occur, and from here to there, if we go to a situation where gold becomes literally the anchor of the entire system and it's measuring everything. I mean, gold goes into premium, and that's why those who hold gold from here to there will gain in terms of real purchasing power in virtually anything you can name. Silver has even more upside potential in that kind of scenario. So, like I said, in between 1980, it got down to 2.6 ounces to buy the S&P 500. That was like the spike low that it got to. And right now it's like 190 ounces to buy the S&P 500. So You know, you can run the math on it. It's like, I mean, that's like 15, or I had to run the math. It's a lot. You know, I'm going to do it right now, just so everybody knows.
Yeah, please.
190 divided by 2.6. That's an outperformance of over 70 times. If you get a move like that, right? And I'm not saying it's necessarily going to happen. It could just be from 193 to say 25, or it got in the lows in 2011. That's that's an outperformance of 7 to 8 times, right? I mean, you don't have to go to these extreme levels just to have an outperformance of multiple handfuls. And that's basically what I'm believing is going to occur from here to say middle of next decade. I mean, you have to remember, in the Western world, the authorities know this. They know that they have to devalue the dollar. They can't default on the currency. They basically have to default slowly, right, by debasing the currency and by making it easier to pay things. And they have to keep the stock market propped up too, because they need to have some tax receipts from people cashing out of the stock market. They can't let it go down precipitously. So they'll come in, and the authorities will, to prop it up every time there's a shakeout or whatever it takes. And when AI doesn't actually, perform, they're going to have to shift over to some other sector that will go into a mini bubble in their little bear market in the stock market. But not only it'll stay propped up, and it'll keep, I mean, you got to remember, the vast majority of United States citizens, they just love the stock market. They're just complete fools. They literally keep like 60% of their net worth in the stock market. It's just insanity. And they don't understand how dangerous the stock market can be. I mean, 1929 to like 1950 some odd, it took like 3 decades almost for that thing to come back and break even. I mean, you were dead money for like 2.5 decades sitting in the stock market the last time they did a great taking. So, the concept is, I would not be in some of these asset classes that people are in, because they're literally sitting like ducks. You could have a real problem if you stay in a place where nominally they're smoke screening you and you think you're doing okay, but not necessarily, because you're losing real value to real things like gold and silver along the way.
I would urge people, after watching this and listening to this, to go and have a look at some of those ratio charts that you've mentioned, gold to oil, S&P to silver, S&P to gold, and so forth, because once you are able to zoom out and look at them, then you'll have a much greater, I think, understanding, especially if you're a visual learner, about everything you've just spoken about, James. Uh, I think that's pretty much everything covered, to be fair. I think it's clear that your time frame, if I'm not mistaken, you're looking at mid 2030s, so to speak, and there's a lot of potential across the commodities in general. Just before we wrap up and explain, because I'd like to go into a bit about your work with SD Bullion, if that's okay. But before we do that, is there anything we haven't spoken about that you would like to bring to the listeners' attention?
And yeah, I mean, you can look at my Twitter feed at James Henry Anderson, or it's called at James Henry and on X. I post charts all the time on there. A lot of the charts are from Nick Lard's goldchartsrs.com website. He has really great data sets. And, what I try to post are charts that go back deeper and further than most people's data sets do. Because if you're trying to understand the future, you need to look deep in the past to kind of get an idea as to how financial history may rhyme. The problem is, most people who comment on gold or silver, I call them more or less the gold and silver illiterati, because it was taken out of the curriculum in the universities pretty much since the 1980s onward. All they've been taught about is the Keynesian jive, and whatever Wall Street wants them to think is how the financial world works. But when that falls apart, then gold kind of comes in and reasserts itself. And then they have comments that make no sense, because they've never done any real study about gold. They've never actually done the research on their own. And so in order to learn about gold, you have to do a lot of your own research. You have to actually go out there and do it yourself. You can't be told by some person about how it works. Your best ally in this situation is to actually do the research and to work yourself. That way you don't get shaken out of anything, because it will be volatile down the line, but you'll understand the reasons and the fundamentals and what to look for in terms of, valuations relative to one another, where it starts to be fair value and eventually becomes overvalue, right? So you want to really start to pair off your positions as it starts to become overvalued. I personally am aggressively positioned in bullion. 90 percentile of my liquid net worth is in bullion, because I just know that ultimately the pendulum is swinging that way. At some point, it'll become fair value and then overvaluation. And in that phase, I'll be slowly paring down my position and moving into whatever asset class makes sense at the time, be it, real estate or the stock market at that time. A lot of questions will be, what's the currency system look like at the point? Are we still threatened by hyperinflation? Are they going to, what are these stock markets denominated in? What currencies are they in? Are they stable? These are all questions that you gotta think through. And it's not necessarily that they be domestic U.S. It could be international stock markets. It could be anywhere in the world. So you don't have to necessarily think myopic in the sense that everything is United States revolving. I don't think so. I think in the future it's going to be other stock markets that are probably going to outperform. That'll be the case because right now the U.S. stock market is more overvalued versus any other stock, any other time in history versus the other competing stock markets around the world. So, common sense would suggest that at some point that swings the other way.
And I'll just reiterate what I said earlier on about having a plan in place, having an idea of what you're doing and why you're doing, and that should help, I think, a lot of people listening to this. You mentioned your X profile. I'll link to that in the post that comes with this video as well, just so people can follow you. I'd highly recommend that people do that because of those charts and other things that you mentioned as well. James, just want a quick mention about your work with SD Bullion, because I know you do a lot of videos and you do a lot of work with them and for them. So if you can, do talk about what you do with them and how people can find yourself and your work.
Sure. So weekly, I do a weekly SD Bullion market update. I usually publish it after trading on Friday evenings. So a lot of times people either watch it that evening late. They're like, there's a lot of late night YouTuber people out there who watch it right when I publish it. But I would say the vast majority of them watch it on Saturday mornings when they have a little time to sit down and watch. Generally, the videos are anywhere from like 15 minutes to 30 and 25 minutes. I try and keep it condensed. Of late, there's been a lot more content to cover because it's just gotten so crazy. So they've gotten a little bit longer than I like. Generally, I like to keep around 15 minutes and just give you the short and sweet of what really happened this week and what's pertinent to people who are interested in the precious metals. And so that's what I try and do weekly in and out for people on the SD Bullion YouTube channel. So that's free. I publish it as well on X for free. So people can always check that out. As well, on my X profile, there's a Substack. I'm probably going to start writing on Substack a little bit more and doing regular article posts on there. And maybe eventually I may end up creating some type of subscriber base to at least give them the ability to follow what I'm doing and why I'm doing it down the line. So I'll probably create some type of product on there that people can buy into, and every year, you just pay a fee and you get a quarterly report that kind of tracks the precious metals using data and charts and not just simply words. We're going to use a lot more data and charts because that cuts through a lot of the noise and that really keeps your emotions in check, and it keeps the big picture, in front of us and keeps us sober to whether or not we've reached fair and or overvaluation. And so that's the concept, is that I would basically just be showing people what I'm doing, and whatever they decide to do is their choice, but at least they have somebody out there trying to give them an idea of when it's either fair and or overvalued, and that would be the product essentially.
Well, I'll make sure I put a link to the Substack as well, because this is where the majority of people find the Contrarian Capitalist. So I'll make sure I put all those links in. James, I've certainly learnt a lot today. I really appreciate your time and sharing your knowledge with the audience. It'd be an absolute pleasure to have you back on in 2026 and have a look at the lay of the land then, if that's okay.
Yeah, I'd love to, Robert. It's a pleasure talking with you, and all the best to your viewers out there.
Yep, well, thank you very much. I'll link everything in the notes. James Anderson, thank you very much and speak soon.